Good afternoon and welcome to today's episode of the Dairy Signal. We are excited to have Ben Buckner, Chief Grain and Dairy Analyst with Ag Resource Company, here to give you a market update. And those that are tuning in live, please ask Ben any questions that may arise throughout his presentation. And with that, I am going to hand it over to Ben.
Thank you as always, Amber. Let's jump into it. In our talk before this, there is a lot of things going on, as there has been for the last 6 years. Though in markets are kind of right where we were 2 weeks ago and 4 weeks ago. So you wouldn't know it if you were just looking at price. And I think that's kind of where we'll start. I mean, we want to give the viewers here real insight into the future of grain and dairy price discovery. And so we think that the structure really hasn't changed that much in the last really 3 months. And we kind of struggle to identify what's going to change it in the next 12 months. And so I know that we started 2026 out talking about the absence of energy market inflation. That was proven incorrect. But I think when we isolate corn, soybean meal, protein meal, soybeans, wheat, and dairy prices, I think the most probable scenario, without barring majorly adverse weather in the northern hemisphere, I mean, the next 12 months I think are going to look pretty similar to the last 12 months still, and that kind of goes across the board. And so I just think that something new and big is required for that not to be the case. And so you kind of have wide-ranging, broadly neutral markets. What is next? What is going to change this? And so this is something we've shown every 2 weeks for the last several months. And even I am surprised at how well this kind of general idea has held. It's both the bulls and bears struggle for leverage. We alternate weeks. When 1 week we get, kind of a flood of US and global milk production data, it looks very bearish. The next week we get, like this week, we get export data, and it looks very bullish. I think the net result is we're still just kind of stuck here, though, like recently, we do want to communicate, one, I think dairy operating balance sheets on balance get better, not worse, through the rest of the calendar year. Okay? We're not today concerned about feed prices. I do think physical cash milk prices, like normally, will be inching up at least for the next 4 or 5 months. Still, it's Q1 2027 in terms of weakness in milk and dairy markets, and that's always the case. That is not unique, but the collision between those normal seasonal trends, we've highlighted just per day US dairy consumption at its lowest in January and February. Kind of that, along with an eroding global market, higher foreign production, and we're starting to see some holes in total US dairy disappearance. And I don't think it's something to be concerned about for the rest of spring and into summer. But what does class 3 specifically look like Jan-Feb 2027? I think it could kind of mirror what we saw last year. So, and again, we've got time to do this, but that's, I think, where we want to put our risk management hats on, or what we want to focus on. Otherwise, here we are. It's still a wide-ranging neutral trend, and you still kind of know exactly what to do when you're at certain prices. Now, I know June is coming up, but if June is below $18 a hundredweight and you're an end user and that matters to you, you buy it. If June is above $18.25 a hundredweight, you know exactly what to do. You sell it. And I think that is the case with forward contracts as well. I think that the catalyst or the target that we've got for something like September class 3 is still $19 a hundredweight. We have not been able to find the ammunition to get us above that or over that hump. And again, like I said, I don't think the overall structure of markets will be allowed to change in the short and medium term. So that advice is still intact. We kind of revisit this as we have seen slowly but steadily spot class 3 and class 4 kind of move higher every month that goes by. And so we can kind of extrapolate or back into what those actual milk checks will be April, May, June, July, August, and September. And they kind of all align at the same price. So we think that cash milk prices in May and June will be $20 to $20.50 a hundredweight, upside to maybe 21, 21.5 in Q4, which is always seasonally when cash milk prices peak. So that is not remarkable in this sense, but it does improve. I think that's important, and I think that the futures market is kind of showing us that. As bearish as things like we'll discuss, total U.S. dairy disappearance, foreign production, et cetera. So a lot of demand for protein, a lot of demand for fat. We know that every year we're going to lose milk production after the month of May or June in the northern hemisphere anyway. So things kind of will stay balanced in that sense. Otherwise, very little change with respect to, I think, total dairy operating revenue. Beef crosses are going to work indefinitely. Each time that the trade has tried to break U.S. cattle markets, it proves unfruitful. And I think most recently, we talked about 2 weeks ago the cattle on feed report, for the month of April that did lean a little bit bullish. We're just not growing herds, we're not growing heifer numbers in the beef cow herd. Cow herds from last year getting smaller, at least on feed supplies. And I think we've got to contend with maybe Western United States drought and how that impacts the nuance of cattle movement is kind of unknowable, but it's not good. I don't think it kind of portends some expansion in beef cow numbers through the rest of 2026. So it's got a long-term uptrend, probably continues if it's not as pronounced as it has been in the last 24 months. So we're going to plant the seed, and we'll kind of get into seasonal price trends towards the end of this. But just do keep in mind that beef prices, it's based all rooted in physical supply and demand, do tend to peak June, July, barbecues, etc. So be mindful of that if we think about the need or desire to hedge, beef cattle production. I think that is still a pretty good time to get that done, and for the next 6 or 8 months. That's where you want to hedge that forward production. But to us, we're still in this structural beef cow bull market, and that probably doesn't end until maybe 2027. And we're just kind of struggling to find what will be the catalyst to meaningfully break the cow market, and that requires absolutely some kind of expansion in herd sizes, and that's just going to be very, very difficult. Cows are expensive for no other reason. So what is going to be the spark that starts this process? And even recently, if kind of the icing on the cake has been the loss of, cross-border feeder cattle trade between Mexico and the United States, that probably is not going to start anytime soon. So what you're looking at here is just sort of confirmed cases of screwworm as of May the 3rd. And it's not really getting any better in Mexico. And in fact, last week, I think it was April 28th, the Florida Commissioner of Ag placed further restrictions on cows entering Florida from South Texas just to be safe. Any cow that does move from Texas to Florida, I think increasingly probably any other state's going to have to undergo further and pretty rigorous inspection. So this is all, the movement of cows between the Mexico and the United States getting worse, getting restricted. It's not improving. So we're kind of left with what we've got. And that's why we kind of reference on feed reports are not indicating any future expansion of any kind. And so I do think that the beef markets at this point kind of rely on the dairy operation to kind of band-aid the loss of supply elsewhere. So they're going to have to pay for those cows, and those are going to be valuable. So that is still an excellent source of revenue, stays that way for the rest of the calendar year at least. We're also finding, at least through March, and there are caveats to this, but something we've highlighted until the last couple of weeks, maybe the last 30 days, U.S. dairy was very, very competitive. Let's call cheese cheap in the global market. And that does not by itself mean much on a weekly basis, but it is aligning perfectly with how much cheese and butter that has been made to disappear over the last really 15 months. And so the dairy export data that was published, just 2 days ago, just pretty incredible. All-time record, 265,000 tons, all dairy products shipped in the month of March. Not completely unexpected, what was very, very robust. Cheese exports of all varieties in March, 63,000 tons, incredible. Year-to-date cheese exports are up 23% from last year. Last year's first quarter total was up 7% from the previous year. And so we're producing tons of milk. We're starting to produce more cheese, but that is all being absorbed by foreign buying interest. And we've been surprised in the data this week that even the Middle East still kind of finding ways to import into probably Red Sea ports or overland from some other port that doesn't require the Strait of Hormuz for transport. So it's very much intact. U.S. dairy export share of world trade still there, and still probably continues for another 30 or 60 days. Would kind of suggest though that the cheese that was shipped in March was purchased way before March when cheese was up to 65 cents per pound below competing markets in Oceania and Europe. Does that change moving forward? And that's, I think, the big question that we've got. So again, our goal is not to kind of give you the headlines of news reports or newly released data. It's what's coming at us. So kind of analyzing that, it does seem like maybe increasingly more challenging to sustain the share of trade that we found the last 24 months. And so since our last conversation, another thing that was surprising or noteworthy, I think, was New Zealand and Australian milk production. There was really just no sign that pretty substantial growth there ends. And for now, they're not experiencing kind of the intermittent weather issues. It's since 2022, for the most part, it's been too wet in New Zealand, too cloudy, or there have been periods of drought in Australia. Today, we're not dealing with any of that. We're still dealing with, I think, pretty decent incentive to maximize yields, at least in Oceania. So production there continuing to grow with 2.6 million tons in the month of March. That was up 8%, or 400 million pounds year over year. We haven't quite got to the point where Australia and New Zealand seasonally shut off production. That occurs during our summer. That happens every year. But for now, they're still kind of adding to global milk inventories, butter supplies, cheese supplies, and powder supplies. I don't think this goes away for the rest of 2026 either. And I think that's something that we want to keep in mind. We're not telling you why is AgResource telling you to think about hedging Q1 2027 milk production or targeting September at or above $19 a hundredweight. It's not the WASDE reports that we see every month, or it's not U.S. milk production, U.S. supply and demand. It's foreign production. It's a world market. And so the core reason that we are recommending things like this is because we're seeing production growth, pretty incredible growth, in places like New Zealand, France, the Netherlands, Ireland. That all competes with the things that we make here. So that is the core of why we think the way we do. And in raw material markets, especially the ag markets, trade flows over time, at least, are completely explained by price spreads. So this is something that we've showed the last couple of signals, and we want to show again because US and European cheese, for the first time since autumn of 2024, are offered at parity with one another. So I don't think that necessarily funnels, an incredible amount of demand away from the US to Europe, but there will be on the margin competition. And there really hasn't been competition for cheese share globally the last 12 months, but that is the case. So what you're seeing here, again, the black line is whether we are at a premium or discount to the European cheddar market. The blue bars are exports in tons. And so it's pretty clear to see that once the US is above the European market in cheese prices, we lose market share. And when we're below Europe by 60 cents per pound, we gain a lot of market share. So we're kind of at a point now where we've got really, really strong export data, record export data through the month of March. But since then, the spread and the price relationship between us and competing origins has shifted pretty considerably. So on balance, will cheese exports, maybe conservatively stagnate? We won't see the growth, at least that we've seen the last 15 months. And that's kind of a concern of ours. But we're also seeing, production data. It's always released, 30 to 45 days late. And it hasn't had the impact on foreign markets that we thought until now. So whether it's, the bi-monthly global dairy auction, or once or twice a week, we get updates from physical cash markets in places like Argentina, Europe, and Oceania. The markets are starting to extract, not add, risk premium. And I think it's just consecutive months, whether it's been 8 or 12 consecutive months of milk production growth in Western Europe, and Argentina, and Oceania, those markets are starting to relax. And so we're still not uncompetitive, but our edge has been, I think, trimmed quite a bit, and that goes for butter as well. So this week's global auction cheddar price was down about 3 cents per pound at 209. The auction's butter price was down another 5 cents per pound at 251. It peaked in March at about $3.10. So just the evolution or the general movement of global prices is something that we focus pretty intensely on. And again, wanted to communicate with respect to managing risk, especially in Q1 2027, world markets prices are going down, they're not going up. And that is because we're still producing a lot outside of the United States. And even with exports, this has not been exactly the case the last couple of months, but the last couple of years. But we did want to highlight that every year, and I think maybe this explains to some extent the lack of reaction in physical markets and the futures markets this week and last week. Exporters knew how much they were shipping in terms of cheese and all dairy products, but it didn't really mean a whole lot. Price discovery. Every single year, we tend to peak U.S. dairy exports in the month of March. And this generally follows production levels, so it's not terribly insightful, but I do think since peak export season now has come and gone, it's kind of the collision between, let's say, previously unexpected loss of market share because European cheese is getting cheaper, New Zealand butter is getting cheaper, and what is already seasonally waning interest from foreign buyers through the rest of the calendar year. I think it's that collision that probably, again, just keeps the recent structure of the dairy market in place for the foreseeable future, the rest of 2026. That's why when we see that we shipped just an incredible amount of cheese in the month of March, it didn't do much to the market because that's probably peak exports. We're producing adequate amounts, and we know that export demand, for a lot of reasons, probably declines for the rest of the year. So, forward thinking, futures markets, especially about the future, and that's why I think there was not much of a reaction because, again, peak export season is in March. That's come and gone. What does the remaining kind of 8 months of the calendar year look like? And that's, I think, the big question. We're also just kind of finding balance in things. So again, this alternating between supplies are very large, but demand till now has also been equally large. Markets, little change, wide-ranging neutral trends. But that's, I don't know if this is going to change or if it's just kind of 1 month of data that is, we can explain some way or another. But we did want to say that the reason butter, I think, which was very, very tight, the market was not loose in February. Stocks were down 16% year over year. And it was going to be, we thought it was going to be very, very difficult to build inventories. But now we're kind of finding that for a lot of reasons, net exports on the margin decreasing a little bit because foreign butter is competitive again. But production is starting to outpace consumption. So butter stocks March 31st were 289 million pounds. That is down only 11%. So I know we're splitting hairs here, but the discrepancy is getting narrower and pretty quickly. Production of butter in March was up 1%. This was out yesterday at 232 million pounds, which the production data we don't really care about because we already know stocks. We know stocks 2 weeks before we know production. So to us, the production report allows us to actually dig into what was consumed that month. That's the last piece of the puzzle. And it was kind of disappointing. And again, I don't know if this is just an abnormality, will be kind of a one-off, but actual butter disappearance in the month of March was just 168 million pounds. It's 224 million a year ago, and counter seasonally pretty weak. So this explains why butter stocks are being allowed to expand faster than we thought, and why the cash market does not really care about inventories being down year over year. Because if we do extend this period of weak total demand, everything's fine. The end user is not going to chase rallies, not going to be concerned about existing inventories. So that I think explains the butter market. That's kind of the beginning and end of it. Cheese and cold storage as well, up slightly, about 11 million pounds from February at 802 million pounds. Still down from last year, but like butter, you can kind of see that once we back into actual disappearance in the month of March, it was only 445 million pounds. 490 million pounds a year ago, and counter seasonally, for some reason, we lost something in the demand side of the cheese balance sheet. And I think it will be made up, but again, there's just not that supply fear that we thought we might encounter based on very, very strong export demand. That's just not the case today. So this is something that we will again revisit in 30 days, but it's a trend that I think needs to be followed pretty closely. If we start to, on the margin, lose total demand at a time when we're, expanding production both domestically and abroad, does this kind of collide with one another and give us weaker than expected dairy markets, especially late autumn, winter, and into the early part of next year. So this is something, again, I think it's important that we'll watch. And to that end, maybe this can be explained, and something that we're generally also watching, somewhat concerned about is, war in Iran and its impact on, if nothing else, transportation costs, freight costs, energy costs. So the Baltic Dry Ocean Freight Index is kind of a decent proxy for how much one has to pay for a boat, on a daily basis, an ocean going vessel. So it's the highest it's been in more than 15 years, $2,832. That's more or less the daily price to charter ocean going vessels. The cost of demurrage increasing, not decreasing, historically high and trending upwards. And so I think this is going to start to impact a lot of things. You're more or less doubling transportation costs this year relative to last year. Does that weigh on discretionary buying, spending for things like dairy, wheat, crude oil for certain? We're already kind of hearing and seeing signs of rationing or restricting things like restaurant hours, miles driven in parts of India, Southeast Asia. Does this expand, or are we allowed to resolve this by opening the Strait of Hormuz fully? But until it does, I think we're both concerned about one, raw material prices, ag markets being kind of a proxy for inflation. That is one side of this. The other side of this is, since this is not a demand-driven spike in energy markets, does this ultimately kind of hinder consumer spending? And are those kind of a wash? Do we as a world eat fewer tons of food because transportation costs are up? So I think this might spill into some of our analysis more frequently. Just what is the cost to move things from one country to another? It's very expensive today. And while the crude markets corrected pretty considerably this week, hope for a deal, as is the case in 2 weeks or so. China, we think, has blessed our most recent proposal for peace between the U.S. and Iran, which is a big deal, I think, because China is a big customer of Iranian crude oil. But this does linger in the background. So I think that the risk, to the farm, of diesel prices going higher, or $130 to $150 crude oil, is only eliminated if the straits reopened. And so I know futures markets, general sentiment will be changing on hope or pessimism that this doesn't get solved in the next 2 weeks. But in the background, not last week, but the previous 2 weeks, the U.S. was a net exporter of crude for the first time in history. So we're kind of band-aiding supply issues that exist in the Middle East. The U.S. motor gasoline balance sheet and crude oil balance sheet is getting tight very, very quick. And so this is not yet an issue. We are producing record amounts of crude. We've got the supplies. Even gasoline stocks still higher than they were 3 or 4 years ago. But at what time does this start to change? If these trends continue for another 4 weeks or 6 weeks, the gasoline balance sheet gets very, very tight. Physical supply and demand of motor gasoline will be kind of historically tight if this thing isn't resolved in 6 weeks. So we don't want to commit to this week the Strait of Hormuz is going to be opened on June 1st or not. I think because we're just taking it day by day. It's either open or it's closed, and it's still closed today. We just don't have a lot on hand. So again, it's fine. We're pretty close to the 4-year average today. But if this were to change, even to keep commercial crude supply and demand balance, we've withdrawn about 11 million barrels from the strategic reserve in just the last 2 weeks. And so again, I think one thing we're hopeful for a ceasefire that's lasting. We open the Strait of Hormuz. At the same time, we can't do this forever. We cannot continue to withdraw from our strategic reserves. We've only got less than 6 weeks on hand currently. Does that drop closer to 5, 4.5? That's going to be a big deal for energy markets. So that is the caveat to all of this. Energy prices, the risk of higher energy prices is only gone once that strait is open permanently. So just wanted to communicate the crude balance sheet, and even the U.S. is getting tight pretty quick. But again, kind of going back to dairy, feed markets, overall structure, not much I think can change it outside of very, very adverse weather in some exporting country. You get famous last words so far. Northern Hemisphere outside of the Western U.S. plains, so it look pretty good. So we're kind of stuck here. I'd say corn's fair value, even accounting for harvest lows, is between something like 410 and 485 when we think about December. Fertilizer is a big unknown, and I think very, very important. But South American corn production, that growing season's almost over. I think they're going to have an incredible amount of corn and an incredible amount of soybean meal produced for the rest of 2026. More corn than we've ever seen. So we've got to contend with that. I think part of the market will be focused on the price of crude oil and fertilizer. The other part will be focused on, we have a lot of the stuff, we need to get rid of it. So we're stuck. We're also looking at, you're starting to, weather is starting to sneak into long-term price forecasts, and it's been cooler than normal, certainly colder than we'd like, but overall, not a lot of issues outside the Western U.S. Even Australia, which almost, it's not every year, but 8 out of 10 years, if El Nino is in place, which it is now, just last week, you have drought in Australia, but they've been kind of, let's call it abnormally wet since the first part of January, and they're going to get more rain in the next 2 weeks. So even in Australia, we're not looking at issues today. So to us, there are a lot of supplies. I think that there will be record supplies of corn, wheat, and soybeans globally and in an exportable position. But I think the other side of this, thinking about maybe post-September 2026, what will the cost of production be? In our heads, I think it's the fertilizer market can sort itself out at a certain price, even if the strait were to stay closed for another, 60 days or indefinitely. But we also know that over the last, 3, 4, 5 decades, price of corn, beans, wheat is going to be more or less on average the cost of production plus or minus, 5%. So just thinking about that without being able to get into details, does cost of production increase to $5 a bushel for corn, $5.50 for the South American producer, come September, October, and then the U.S. next year. And that's kind of your guidance on where the market goes, I think, after we get through the Northern Hemisphere harvest, at least. And we can't answer any of those questions today. That will depend on whether the strait is open. And we think that fertilizer, too, talking to people smarter than us, it may take 4 weeks, 5 weeks, but that's probably it. We can probably get back to something like adequate flows of nitrogen-based fertilizer. So if it is opened, we're going to be fine. South America is going to be fine. But if it's not, then we do have problems with respect to cost of producing corn and wheat. Do you plant a lot less of it? Do you plant more soybeans? Those are things we'll have to kind of reassess or revisit come middle of August or so. Otherwise, soybeans do have value today because of crush margins, just incredible. You can look at sort of Bunge stock prices, net income, et cetera, just gangbusters, to the point where a lot of these companies are focused almost solely on crushing soybeans in the United States. To meet this expanding biofuel policy, at least between now and 2028, I think we're going to have to use something like 40 billion pounds of feedstock to make the appropriate amount of biodiesel and renewable diesel. We think that at best, soybean oil can only account for, I'd say, maybe 20 billion pounds of that. So we've got to somehow encourage capacity expansion, new plant construction. We have to import lots of stuff to meet this mandate. So soybean oil is going to stay expensive, and soybean crush margins are going to stay above $2.50, $3 per bushel. So what is the downside in soybeans if that is the case? Lots of protein meal will be produced. I think that we are unconcerned longer term that protein meal prices, soybean meal in particular, goes up on a lasting basis. And I think thinking about the market, why has it been so strong recently? And even at kind of interior meal basis has been abnormally strong. We've not gotten to the point where we're benefiting from new, very large South American soybean production. Argentina, of course, the world's largest exporter of soybean meal, probably doesn't ramp up crush until June, maybe July. But at that point, there's just going to be incredible competition to clear inventories, not only from us, but from South America. Do we have the protein feed demand to kind of satisfy what we're going to produce? I think meal prices, again, kind of repeat the last 12 months, where you have risk of sub $300 cash prices and futures prices second half of 2026. We've also got, an emerging issue is, of course, drought in the Western U.S. And we're thinking about, hard red wheat production being something like 580 million bushels. Last year, it was 600 million. Kansas, Nebraska, of course, very sizable row crop producers. Does drought there get solved prior to something like June 15th? Odds seem low today. Elsewhere, though, you kind of outline the principal corn and soybean belt. Drought has been eliminated. Mother Nature has done a lot of work the last month and a half or so. We also want to highlight the kind of Delta Southeast, which is going to this year be a pretty sizable producer of soybeans. And we're less concerned about what is even exceptional drought in places like Arkansas, extreme drought in Tennessee, Louisiana, Mississippi. They're going to get the rain in the next 7 days. They've already gotten a lot of rain in the last 48 hours. And even our producer client, Sarah, said recent rain has been kind of a godsend. Everything looks pretty normal now after suffering through late winter and the very early parts of spring. So I think ultimately, probably drought may not be eliminated, but those crops, south of Tennessee, Arkansas, are going to have access to a lot of water. And as we'll talk about in a bit, I think corn will start to pollinate in places as far north as Kentucky the opening week of June. And so if they get this regular rainfall, we're kind of easing concerned about production everywhere outside of the U.S. Western. But again, that's kind of not the insight. The markets tend to focus on the U.S., but why we are saying that the structure of feed markets, cash markets in the Midwest and globally probably don't change that much. I don't think you can be overly bullish, but you can't be overly bearish as well. It's South America. And again, it's something that can't be taken from the market at this point. They're starting to harvest safrinha or winter corn in Brazil this week. And it kind of expands over the next 60 days. So the growing season, not quite finished, but very, very close to being over. So what you're looking at here is, as of April 30th, Brazilian vegetation health compared to average. And I've highlighted the states that produce safrinha corn or winter corn. And that corn, of course, is planted in February, pollinates April, May, harvested during summer. Better than average. Most places better than last year even. It has been pretty dry in this kind of eastern half. The monsoon withdrew about a week earlier than it normally does. And so I think you do have some problems there. But we together will get into the weeds. I just wanted to show you kind of primary source data to sort of let you know why we think what we do. So one, we're thinking about cash corn in Wisconsin, and the reason that I don't think it changes much over the next, maybe 9 to 12 months. Harvest lows will be similar to last year, then you recover post-harvest, et cetera. It's just because you have a lot of stuff in South America. So one, the first crop, Brazilian corn, which is kind of on a normal cycle. It's planted in October, harvested in winter. It is 28 million tons. Last year it was 24. So you're already kind of putting to bed some amount of supply risk in South America. Safrinha crop, what you're seeing here is we have raised, the largest producing state, Mato Grosso. I think that will be a record crop, just an abundance of rainfall. It was planted early, pollinated without issues. Not really a lot of insight there. We've taken yields down in other states by varying degrees, and you're still left with 106 million tons. We add that to their first and their newly established third production, and we get 136 and a half. For context, last year's crop was 136. The USDA this year is 132. So it's just not very exciting. Brazil is going to have a surplus similar to, or maybe a little larger than last year's. That is going to act kind of as a weight on how much corn the U.S. makes disappear. And the other side of this, and I think we highlighted this 2 weeks ago, but the Argentine corn crop is very, very special. It's kind of uniquely big, like their wheat crop was. And that was always the idea. They planted an incredible amount of stuff. It rained a lot exactly when it was supposed to. And now we're getting yield data. So they're probably this week, last week, they were 28% harvested. Yields are up 5% year over year. It's actual data. The USDA and their Argentine balance sheet, and they're kind of their whole world corn trade matrix is assuming, for whatever reason, corn yields will be down 7% in Argentina. So that is incorrect. They will fine tune that over the next couple of months. But if you put the two together, and talking to our contacts who we want to be, based in reality, what are yields? They do think that this crop in Argentina has potential to be something like 65 million tons. The USDA is at 52. Last year's was 50. So put that with a pretty normal crop size in Brazil, you get 200 million tons, exports of 90. That is up 19 million tons from last year, or about 750 million bushels. So I think that let's take half of that, strip that 380 million bushels or so from the US balance sheet, and you're still just kind of left with US corn supply and demand. In spite of war, in spite of future fertilizer issues, the US corn balance sheet in 2026 will just look a lot like it does in the current year. So neither oversupplied, but certainly not undersupplied, and we're kind of stuck with a 420 cash market for the foreseeable future. And even the cash markets in Argentina, and cash markets are king to us because there's not a lot of sentiment. It is the price of the physical good. You kind of see that Argentina is getting prepared for this record production and oversupply there, at least during the summer months. So Argentine corn can be bought 30 cents below the US market today. Relative to the last 4 or 5 years, that is a pretty large discount. It just kind of suggests that, yeah, it's going to be big. They're going to have to clear stocks. That is going to start to weigh on how much the US market makes disappear every month. So that I think is forthcoming during the summer. When we think about wheat and, its use as a food product, of course, but also kind of its impact on corn, wheat can and is fed in a lot of places, including Asia, including lots of Europe, including Africa. Conditions there are very good. The French wheat crop this week, 81%, good to excellent. It was 74% a year ago. Even that was pretty high. So I think we're on track to have very, very big European and Black Sea wheat crops, maybe corn crops if this absence of weather adversity continues. So what you're looking at here is May 1st to May 20th, percent of normal rainfall. This assumes that the 2-week forecast is correct. And I've highlighted the biggest wheat growing areas of the European continent. So everyone's going to get water at exactly the right time. Vegetation health there above average, above last year. And so I think that even what we're seeing in the hard red market can be sorted out fairly easily by importers, just not like they were a year ago buying a lot of US wheat. They'll buy it from Europe, they'll buy it from Ukraine and Russia. So that is, I think, again, even the wheat market structure probably looks like it did the last 12 months for the next 12 months. When we think about Russia, kind of and its impact on global grain markets as a whole, it's still pretty early. You have to know what weather is the first 2 weeks of June before you can say much about yield performance against trend. But you kind of already checked off some risk. This is vegetation health compared to normal. The Black Sea wheat producing belt is highlighted. And our work would kind of suggest even if you get a lot of rain in April, that's very early in the growing season. You're kind of locked into above trend wheat yields already. It rained about 2.8 inches in the most important oblast in southern Russia. So I think Russia's wheat crop is going to be very, very large. And we think about physical markets. So what is the summer going to look like in terms of cash market price discovery, corn, wheat, and even soybeans? Seasonal trends are bearish. Is there something that disrupts that for the first time in a long time? And even as we're losing, an incredible amount on a percentage basis of US hard red wheat production, this is what I think summer kind of looks like everywhere else. So this is just beginning stocks, which are the largest in years in Europe and the Black Sea for wheat, along with our production estimate, which for now just assume trend, maybe a little above trend. And so we can kind of say this is what the European continent wheat supplies will look like on something like August 10th. It's going to be a record 295 million tons. So I don't think you're going to see physical wheat prices do a whole lot. We've got war, we've got some measure of demand growth, but there's just going to be a lot of stuff around. And the same thing is true for the corn market when we think about total South American supplies. They're just going to be very, very robust. So I don't think the cash market's going to give us guidance to say that all of a sudden, for the first time in a couple of years, we have to ration corn. I don't think that can be the case until 2027 at soonest. And even that depends on if the South American guys can buy fertilizer at reasonable prices. And even with wheat, I just kind of want to show you how grain markets work, and they're fairly simple. So hard red, the supply-driven rally, I think was warranted. Ultimately, this drought did turn into something that rivaled 2022, 2018. Yields are going to be at the lower end of history. We're thinking about a national hard red wheat yield of 35, 36 bushels an acre. Last year's was 45. But notice here that for a lot of reasons, mainly supply, the world wheat market did virtually nothing. It has not cared one bit about drought in the US, nor does it really care about war in Iran or fertilizers. So you can buy wheat from Russia $1.50 below the Gulf hard red market. So I think that we're not going to export any wheat while we're losing production. And that's been kind of the case. So, this is immediately explainable. If we look at the pace of new crop, so 26, 27, U.S. wheat sales since the middle of March. And in the case of hard red, they've been, for all intents and purposes, zero. Because Mexico, and I think this is happening in the physical market, boats from Russia are arriving to Mexico with wheat. Mexico has been one of our most reliable buyers in the last 5 years, but now they're sourcing Russian wheat because it's so much cheaper than U.S. origin, in spite of their proximity to the U.S. market. All wheat sales are down 35% cumulatively, 35% from last year. I think this is just a function of even soft red being too expensive in the global market. So while we're losing something like 225 million bushels of U.S. wheat production, we could lose maybe a similar amount of export demand. So I think this can be sorted for now. There's got to be another problem somewhere else for the structure of grain markets to be adjusted. So we kind of think about seasonal trends, and I'm sure you've seen some of these graphics many, many times. December corn doing what it always does seasonally in terms of adding premium, extracting premium. And even this year, kind of hard to separate war in Iran from spot Chicago corn. It's kind of doing what it always does after harvest. It's up about 15% from last year. That is almost exactly what it's done on average the last 10 years. But then we kind of want to take it a step further. So how valid are these charts? And I think what you're seeing on the right is, basically every year except for 2010, 2012, you had steady to weaker markets during the summer months. 2010, I think it was a function of ultimately Russia, because of weather, outright banned wheat exports. It's a big deal. In 2012, of course, we had kind of a crippling U.S. drought, had to reset food markets. Other than that, markets tend to go lower. And I think that that's a simple way to look at this, but we kind of wanted to dig into why that's happening and why, people think that this year is going to be different, but it never is. And it's just got the general landscape of the markets, one, and this can never be changed. Each hemisphere gets all of their grain supply at once. And so you always have too much of it at or just before harvest, the perception of the market in terms of supplies. And the second, I think the market's always the tightest physically. We have the fewest amount of bushels, let's call it between March and May when we think about something like corn or even wheat. And the market just kind of trades to that end, kind of short-sighted. So that's why we have these trends that are in place. So, and those really can't be changed. So that's why I think that even if you had adverse weather 2019, it really wasn't an impact for price determination until we got after beyond the U.S. Northern Hemisphere harvest. So I think that the default kind of outlook is something like this, to the point where if we're always debating who's bullish, who's bearish. To be bearish of corn and wheat now, and bearish of soybeans after about the first week of June is not even that insightful. That is just typically what happens. I think it's more a measure of what happens after September. Then do we deal with tightening or loosening balance sheets? But for the next 100 days, I think if you're a producer, we want to catch up on things, get things sorted out, at least to manage that risk. And if you're an end user, you kind of know when you need to buy feedstuffs. It's, let's say you scale into things between the last week of July, first week of September, it's always your best opportunity. And this year might be a little different. We will, again, kind of assess weather every couple of weeks. But something that jumped out to us with respect to weather planning progress was just how fast and early corn crops are planted. Mississippi, Arkansas, Tennessee, and Kentucky especially. Louisiana is always very early. It's almost the tropics. But a lot of Kentucky's crop was planted 3 times faster than it was last year and on average. And so they got to 50% planted, about 14 days, 2 weeks earlier than normal. So you just kind of, corn's not like soybeans, kind of extrapolate. Let's assume something like normal GDD accumulation. When will this corn start to pollinate? And I think maybe equally important, when will this corn be harvested? And so we've got pollination, the kind of biggest producers in the South, really the first half of June. Even Kentucky, 50% of that crop will be pollinated by June 24th, we think. So a couple of things. I think you avoid the worst of heat. And also that time is not in the too distant future. So we're going to start to look at weather in the South pretty intensely after the next 2 weeks. And if it's good, I think you're going to have pretty decent corn yield potential in the South. And it's going to be harvested in the month of August. So even Kentucky probably gets to 30% harvested by August 31st. And so you don't really have this very wide bridge between old crop and new crop. And we've seen things like the December-September spread is pretty wide. And I don't know if this is a reason for that, but I think this does support kind of December sustaining a premium to September. And September probably not going to do much fancy because we're going to have a lot of supplies. At export terminals in the Gulf come September 1st. There's not going to be, again, this large gap between old and new crop, at least in the southern U.S. Also thinking about seasonal trends. So Kansas City wheat, Chicago wheat, kind of it looks similar to corn. You typically peak markets almost year in, year out, the month of May, which is what's happened again so far. But what happens during the summer historically, again, you tend to lose value unless something like 2012. And what I've highlighted here are years of droughts that were similar to the current one, when you lost something like 8-12% of yield relative to trend in hard red production. You can see that it has meant very little to wheat price discovery. 2022 was a very bad year, but we were also coming off of record prices, and it turned out that Russia and Ukraine could export grain despite war ongoing there. So I just think you look at this and you think about probabilities. How do you assess risk? Again, I think to us, the outlook is uncomplicated, at least for the next 3 or 4 months. It's after that when I think there's a lot more nuance to the feed markets. Primarily being this, again, thinking about, even calendar year 2027. Corn's going to be more or less the cost of production. What will that be? So far, I think a lot of people have their fertilizer supplies in the U.S. And we know, for example, India's got theirs, Russia has theirs, and China has all of their needs. But everyone's been paying something like 40, 50 to 90% more than they paid a year ago, which is incredibly unwanted, but does the corn market, you can't lose that much production before things do start to tighten pretty considerably. So does the market globally need to pay the producer $5.50, $6 in 2027? Again, unanswerable today, but this is, I think, why corn has been so reactive to crude oil, what's happening in Iran. Even this morning, I think corn, soybeans, and wheat kind of followed crude oil tick for tick almost. And that's probably going to be more or less the case, or at least linger in the background. And we're thinking about, again, post-harvest, what happens in South America. Do we kind of undergo this period of relative balance sheet tightening because we're not planting as much, we're not applying as much fertilizer, et cetera? And so that is the long-term risk. But overall, again, not much changes 2 weeks. We like I think dairy producing margins get a little better, not worse the rest of the year. And I think feed markets will kind of stay where they are now or get a little cheaper from now until August 15th at least. So thank you as always. And any questions, rebuttals, complaints are always welcome.
Well, thank you, Ben. We did have a question come through from a viewer. It reads, which could have a bigger impact, screwworm or the Justice Department confirming an active antitrust investigation into U.S. cattle and beef markets?
I think long-term will be screwworm. That's not something that we can fix. And so we can, government involvement, et cetera, you can always kind of short-term maneuver markets and sentiment, but until screwworm is gone, we are not going to have an expansion in cow herd. So that's got to be licked before that begins.
Okay. All righty. Thank you for that. And then just to wrap up here, what are just a couple key takeaways that our viewers should know about before we sign off today?
Yeah, I think the number one thing is, again, these markets look pretty clear to us for the next 3 months. Dairy as well. But after that, there's going to be a lot of nuance here. And so we've always been of the mindset, since we're not in this ultra bullish trend like we were, 2020, 2023. Just think about risk management. We want to protect margins way more than we want to call highs and lows. So get into the balance sheets, P&Ls, take a look at milk through, start entertaining the first half of 2027. And we want to keep people profitable and in business. And I think that's going to matter more 26, 27 than it has even in the last couple of years.
Alrighty, well, thank you, Ben, and thank you to everybody at Egg Resource Company for their continued support of the Dairy Signal. We will see you next week and have a great weekend.